Tim Melvin is a man who needs no introduction. He has spent the last 27 years in the financial services and investment industry as a broker, advisor, and portfolio manager. He's also written and lectured extensively on the markets. His work now appears on realmoney.com, as well as several print publications, including Active Trader and the Wall Street Digest. Mr. Melvin has also collaborated on several investment books published in the Wiley Little Book series of investment books. Mr. Melvin is a practitioner of the Benjamin Graham School of Value Investing. He's also well-versed at using option strategies and leverage to improve and enhance the portfolio risk and return to form a basic asset-based portfolio. Most recently, and this is exciting, Tim Melvin launched the Tim Melvin Deep Value Letter on Marketfy for the first time ever. And this is something that we're really, really thrilled about here. For the first time ever, all of us can follow along with Tim's portfolio and receive his investment recommendations the moment that he makes them. So all of Tim's gains in these markets are gains that subscribers can make as well. So without further ado, I introduce to you Mr. Tim Melvin. How you doing today, Tim?
I'm doing real good, Nathan. I hope I can live up to that billing you just gave me. Pretty excited to be here today. We've talked about doing a newsletter from a value investing perspective for several years now, and I finally found a partner in Marketfy that gives me the infrastructure and the support and the administration support really to get this done. I'm kind of a one-man operation, and it was a little daunting of a task to do it by myself, but I think I've got some pretty good partners here. So today I want to cover I want to cover what we're going to do with the Deep Value Letter and maybe answer some of your questions about why you would want to use this kind of service. We'll talk about why listen to me. After all, there's literally thousands of people out there with a market opinion. Why on earth should you listen to Tim Melvin? Why value? I mean, there's all kinds of stuff to do out there in the stock market today. Turn on the TV or boot up your computer. Yeah, there's a million different guys with a million different ways of approaching the stock market. So why use a value approach? It seems kind of boring to most people. I'm going to try to walk you through the process, how we pick and evaluate stocks, how we manage portfolios, give you some idea of the type of results and successes we've achieved over the years, and then what you can expect from me in the newsletter, because I'm going to try to make this more than just, here's a stock, go buy it. I want to make it informative, educational, as interesting as possible for you as a subscriber. So let's just kind of move along here, and we'll start with, if the page will click, there we go, why listen to me? First off, I'm not real good at tooting my own horn, guys, but I've been doing this for 27 years now. 25 years experience as a broker. I still manage private portfolios for family and friends. I've been around and survived through a wide range of market conditions. During that time, I've had the opportunity to learn from some of the very absolute best in the investment business. You know, I worked with Chris Brown on the book he wrote in the Wiley Little Book series, and I met some of the other partners at Tweedy Brown, and I learned an enormous amount about the value investing process from them. These guys were Benjamin Graham's broker back in the 20s and 30s, so they were kind of there at the dawn of value investing, and I picked up an enormous amount of information from them. I'm also a little bit of a geek. I like to study what happens in the market. I probably read every important academic study on stocks in the market that's been released on the subject of how individuals can make money. We continuously come back to the fact, as I'll cover in a minute, that value investing, when properly practiced, works, and it works very best. I've based my style over the years, of course, on Ben Graham. We've taken a lot from investors like Marty Whitman at Third Avenue Value, of course, the folks at Tweedy Brown, particularly Chris Brown. And more recently, James Montier of GMO Asset Management has done some really groundbreaking research on the value investing process. So I've learned a lot over the last 30 years. I've been taught by some of the absolute best investors in the game. I've achieved some pretty solid results over that period of time. And I've survived through a lot of cycles when a lot of other guys just simply aren't here anymore. So hopefully, I can use the experience and the knowledge that I picked up over the years to help you improve your investment results. Now, here's the big question I'm asked all the time. Why value investing? Value investing seems to be the absolute most boring thing that you could possibly do. I mean, look at your TV during the day and all the really exciting stuff that's being pitched out there. There's day trading, swing trading, there's options, futures on options, just all kinds of, and it seems exciting. You can make millions of dollars in weeks, according to the commercials. Value investing is slow and boring. It's in the eyes of most people, but it's a concept that was developed by Graham over 90 years ago. And during that time, it's consistently delivered above average returns. Today is absolutely no different. If you look at the best value managers right now, they're blowing the market away. In spite of this fact, most people still tend to gravitate towards the shorter term trading, towards traditional Wall Street research that is emphasizing gains of 15–20% over 6 to 12 months, trading based on the income statement and the earnings report. Maybe more exciting, you may spend more time doing it and make a lot more trades, but I don't think over the long run that you will ever make as much money as applying patience and the discipline to make value investing work for you. Now, I know how to do this. I've been doing it for a long, long time. I can help you put together portfolios of safe, cheap stocks that will do well regardless of market conditions, and over an average market cycle of 3 to 5 years, you should substantially outperform the market. Now, when I started to do this, I almost got carried away and ran through all the value investing studies, but there's just simply too many out there. I'll start with the original one that was done by Professors Fama and French at the University of Chicago. They looked at the stock market from 1963 to 1990. Their original goal was to prove that the markets were efficient and there was no way to really gain an edge on the stock market. What they found was that the smaller stocks that traded at the lowest multiple of price to book value outperformed the more popular glamour stocks that traded at higher multiples by 3-to-1 margin. They also, over that period of time, and that's 27 years in the study, they better than doubled the stock market's rate of return when you compared it to the S&P 500. Now, when they did this, they broke the stock market into deciles, groups of 10%. All the stocks in the lowest 4 deciles, measured by price to book value, beat the market by more than 50% over that extended period of time. It wasn't necessarily the most exciting thing. You didn't own the Nifty 50. You didn't own the most popular and exciting stocks at any given point in time. But you consistently beat the stock market rate of return, and you earned far more money than you could by using other methods of investing, including growth stock investing. Now, that's nice, but 1990 was just, over 20 years ago. So let's take a look at some more recent results. A couple of guys by the name of Wesley Gray and Tobias Carlisle just came out with an excellent book called Quantitative Value. And they took a look at stocks trading at the lowest percentage of price to book value again. And they looked at this from 1964 all the way up through the end of last year, 2012. Stocks trading at that lower price to book value multiple returned 13.11%. The S&P 500 over the same time returned about 9.2%. Now, over that period of time, if you put $1 in the S&P 500 at the start of the study, it grew to $81.92. That's pretty good. If you own the lowest price to book value stocks, it grows to over $520 just by practicing value investing and buying stocks that trade well below their tangible book value. More interesting book just came out. I just finished this last week, so I threw it in the slide. It's a book out there called The Net Current Asset Value Approach to Stock Investing by a guy from St. Louis named Victor Wendell. Victor looked at one of the extreme measures of value that we use, and that's stocks that trade below their net current asset value. In the last 2000 to 2009 was the worst decade ever for stocks. Stocks actually had a negative return of almost 2%. If you focused on the very cheapest stocks in the marketplace, you actually earned 27.04% annually during a decade when nobody else was making money. There's thousands of these academic studies out there. Some have been done by practitioners like Tweedy Brown, professors from the University of Chicago, from the University of Michigan. They all come to one conclusion. If you focus on stocks that trade well below their asset value, you end up beating the market by a very high percentage over a period of time. It doesn't outperform every year. In fact, about a third of the time, this approach will underperform the market. However, when you look at the 3 to 5 year market cycle, it almost always outperforms, and by a significant percentage.
Hey, Tim, before you go ahead.
Here's where I come into play, guys. Right now, sure.
We've got a question from Doug.
Go ahead.
Doug is curious. He said
Okay.
that he's curious about, because the studies that you're showing go back to the 1960s. He said that that style of investing may have been relevant back then, but in today's day and age with high frequency traders, isn't buy and hold dead? What do you have to say to that, Tim?
Well, we're not necessarily buy and hold. We're buy cheap and sell dear. I'm not, when a stock reaches its full value, and I'll kind of get into that a little bit more, I'm going to sell it. I don't buy and hold forever. Also, what we find is that high frequency trading has made an enormous difference in large cap stocks. However, most of the stuff that I buy is not in the tradable indexes and ETFs, so we're not impacted by it quite as much. We'll get a little bit more into the process and how we avoid some of the pitfalls, but yeah, the returns from value investing are still there, but it's really not buy and hold. Wall Street sold everybody on that buy and hold 10% a year thing, buy indexes and just hold them. The last decades has shown us that that clearly does not work. We're buy cheap and sell expensive, not buy and hold.
Thanks, Tim.
Okay, does that answer that one pretty good?
Oh yeah.
Okay, here's kind of where I come into the value investing process. Right now, I ran a screen last night. There's about 2,000 stocks listed in the United States that actually trade below their tangible book value. Now, most of us can't. Nobody can own 2,000 stocks unless you're running one of the biggest mutual funds in the country or having a huge exchange-traded ETF. If you take those 2,000 stocks, you have to start to screen them down. So what I have right now is 2,000 stocks trade below book value. Less than 1/2% of those stocks are strong buy candidates using my portfolio analysis and techniques right now. As I said, I've been doing this for a very long time, about 30 years. I like to think that I've gotten better as I've gotten older, and I've learned to develop tools that allow me to separate the wheat from the chaff, if you will, and find the stocks that are cheap and also safe and qualify for purchase right now and have upside potential over the next several years. A lot of stocks that trade below book value do so for a reason. They're on their way out of business. Net book value is shrinking. They have too much leverage. They've made critical business mistakes. The trick is to find those that are going to survive and thrive. So here's what we have to do. We have to narrow the pool. If we break the market into deciles and just tried to buy the cheapest 10% based on price to book value, that's still 1,000 stocks. Again, you have to be running an enormous pool of money to buy 1,000 stocks. So what I've learned to do is draw on people like Joseph Petrosky of University of Chicago, Edward Altman of NYU Stern Business School, and some distressed set guys like Marty Whitman, and develop credit scoring and fundamental scoring systems to help us narrow the pool. We want to find the stocks that are cheap because they're out of step with the market, they've made a temporary misstep, they're in an unpopular sector, but the companies are going to survive. That's the most important thing. The stock is cheap and the company can survive. We've put ourselves in a position for good things to happen. By adding some fundamental qualifiers, we try to find those that are on the verge of improving sooner rather than later. With that thought in mind, every time we look at a stock, I derive 3 prices for every stock. First, I want to know what's this company worth as an intrinsic going concern, in good shape, going forward, valued as an ongoing business. Then we figure the tangible book value. We take book value, we subtract a couple things that we think where the value cannot be realized, such as goodwill, and then we derive a liquidation value. We want to know what's this company's worth if they break it up, sell everything, and return the cash to investors. Our process is going to work something along these lines. When a stock gets to a certain discount to tangible book value, it's usually around 80%, and it passes our credit tests, I'm going to be a buyer of the stock. If it trades back down to under liquidation value, I'm going to buy more of the stock. If it trades up to the intrinsic going concern value of the stock, I'm probably going to be a seller of the stock at that level. It's fully valued. And what happens is we run these numbers every quarter for every stock in the portfolio. We're buying companies where they're out of step with the market. Business conditions probably are not perfect for that company. As things improve, all 3 of these numbers are going to go higher. Sometimes they don't. We end up just selling within a year or two at the intrinsic concern. But if that intrinsic going concern value keeps going up, we're going to own the stock for several years as the business improves and the value of the business and the stock price continue to go higher. That's the perfect situation for us. But we want to take that pool of 1,000 stocks that are the very cheapest on a price to book value basis and bring them down to the 50 to 100 stocks that are going to do absolutely the best for us over the next several years. Now here's just a quick example of one, a recent addition to one of my portfolios, Alpha and Omega Semiconductor. This company is just kind of bumping along with the economy. They posted a loss last quarter. Business is probably not going to get a lot better for this company until the electronics business picks up over time, and that's going to require the global economy getting better. However, the stock's right around $7.69 today. Tangible book value is $10.47. The liquidation value is $7. So I own the stock here. If it goes under $7, I'll buy more. If it gets up to that going concern value of $13 to $14 anytime soon, I'm going to consider selling the stock. However, if earnings start to get better, that going concern value is going to go up to $15, $16, $17, $18 a share over time. We're going to try to hold the stock until it hits its full intrinsic going concern value. Okay, and real simple, I went back through the archives on Real Money. I've been writing there for about 5 years. I wanted to give you some idea of the type of stocks that we buy and exactly how well this might work for you over time. So let's just take an example of a few stocks. In late December, everybody wants to write the stocks for the next year portfolio, and I'm no different, I guess. I did this at the end of December of 2012. We picked 4 stocks for 2013. Now, Hardinge is a pretty simple little company. They make machine tools. They sell in Europe, the United States, and in Asia. Very boring little stock. Everybody was worried about Chinese growth, so stock was trading at about 75% of book value. Absolutely nobody was paying attention to this thing. They had a couple decent quarters. Orders picked up in Asia and the United States. Got a recommendation from one of the boutique firms on Wall Street. Stock is up 54% already this year. Tecumseh Products, if possible, is even in a more boring business. They make compressors that go into refrigerators and HVAC systems, and business has been awful for several years now. This stock was actually trading at about 40% of tangible book value and below our estimate of liquidation value when I recommended it in December. A couple things happened here. First, an activist investor got into it and started pushing management to make some changes in restructure for the controlling family to exert less control, and then the housing rebound started to make its way into the marketplace, and the stock took off. It's up 142% in the first 7 months of the year. Usually these things take longer to work, but I'm not giving the money back. Bank of Ireland, of course everybody knows Europe has been just an absolute disaster. Bank of Ireland was no different. The stock was trading at about 50% of its tangible book value. You had 2 noted distressed investors, Wilbur Ross and Prem Watsa of Fairfax Financial, come in and put a substantial amount of money in to recapitalize the stock. The austerity measures put in place by the Irish government have started to work. The stock's up 41% already this year. Volt is a staffing company. It's a special situation stock that has not filed their financials for several years now and is on the verge of doing so. The stock's at 50% of book value and about 2.5 times the free cash flow being produced by the company. It's my weakest performer out of those 4. It's up about 13.7% for the year, and we expect quite a bit more from that stock over the rest of the year. Just some other ones. In April, we did a short article on mechanical value investing. Just ran a simple screen for stocks that traded below 90% of book value and hit on our credit metrics. Neutral Tandem was trading at about 80% of book value. It's an internet protocol and Ethernet company. Nobody was really paying any attention to it. Then they reported a huge quarter as spending in their space picked up, and the stock absolutely never went back. It's up 286% since April. Career Education was this company that fit the screen. It was actually trading below net cash. The for-profit education business has been absolutely horrible for the last several years. It's not just the economy, but the business model, the government regulation that the industry was subjected to, and these companies just fell apart. It's not a great company, but it was trading for less than cash on the books, and the market has readjusted its valuation of it, and the stock is up about 53%. Now, Tell Labs is, again, it's the weak performer in the bunch. It's only up about 12%. It's a cigar butt stock. It's in the, sells to the telecommunication industry. Business is not great, but it's trading right around its net cash levels and at a discount to book value. It's pretty much too cheap not to own. It was in April. It kind of still is now, and the stock's up about 12% for the year. Just
Hey Tim,
looking back
before
at
you go ahead, you can
Yeah.
keep going ahead, but I'm looking at these numbers and thinking, what stock investing planet is this? I just want to stand up and give you a big round of applause because these triple digit gains are so phenomenal, and these are just numbers to give people perspective that can change people's lives to get triple digit percentage gains on investments. So bravo, and I'm very, very excited, and I'm sure everyone is really excited. And we have some great questions coming in as well to hear more about on the presentation because
Okay, yeah, I
these
mean,
are gains you can't find anywhere else. So thank you, Tim, and we're all looking forward to hearing
well, thank you. That's
more
very
about
kind.
what
And
you
these
do.
are all part of a portfolio, obviously, but it's when you find
Yep.
stocks that are this cheap, you put yourself in a position for things to go right. If the company's cheap enough and it can survive, you're in a position where good things can happen. And, just running through some more of these to give you an idea. Synovus is a large regional bank. It was hated. They had horrible credit problems coming into 2012. The stock was trading at a pretty significant discount to its book value, but management was on the ball. They've really trimmed the losses there from the credit portfolio. They've actually been profitable 2 years in a row. As the street started to notice this, the stock took off, and it's up 63%. Micron in 2012, I have an extra number in there. That was pretty good. Nobody was ever going to buy a consumer device again. Memory chips were never going to sell. The business was never going to improve, and the company was dead. If you listen to Wall Street, the company wasn't dead. It's up 51% in a year, and is now trading at a slight premium to its book value. Same Albany Molecular is in the contract research business for pharmaceutical and biotechnology companies. Business was very soft. There wasn't a lot of interest on the part of the large drug companies right now to develop early stage drugs. They got a couple contracts, had a couple nice earnings reports. Again, the stock's better than a double on the year. Same thing with Banco Popular out of Puerto Rico. The Puerto Rico banking system is an absolute mess, continues to be, but they're the class of the island, and they have a strong U.S. presence. Once Wall Street realized that, got a couple favorable recommendations. In a little over a year, it's up almost 70%. Republic Jetways, when we bought it in 2012, people thought I was crazy. They were talking about selling a division, but nobody wanted to buy it. The airline business was horrible. Fuel costs were a problem, but it slowly got better. And they decided not to sell the division. They've taken it off the market. That stock has tripled in a little bit over a year. It was trading at a third of a tangible book value when we bought it. Could have literally sold the planes, paid off the debt, and returned about twice the original investment to shareholders. Now, Zolt is a stock that's in my least favorite industry in the world. It's in the alternative energy business. They make the carbon fibers that are used in wind turbines. Although I'm not a fan of alternative energy as a business, the fact of the matter is they're getting subsidies to build these things. This sold off coming into 2012 along with the rest of the wind power industry as the tax subsidies were getting ready to subside. However, the tax subsidies were picked up. Business has remained okay, and they've developed other applications for the carbon fibers with the auto industry, and activists got involved with the stock, and in a very short period of time, the stock is better than doubled. Now, not every stock is going to do that. I don't want to create that impression. But if you have one or two of these in a portfolio, it makes one heck of a difference and really brings your return up and allows you to beat the market. Where we're really different is in our sell philosophy. We hold it until it works or something changes. When I buy a stock, I'm going to hold it until it hits that ongoing concern intrinsic value. I'm not going to hold it for a year. and sell it. I'm not going to sell it based on a chart pattern or market psychology or market movement. I'm going to sell it based on when it hits full valuation. I've owned stocks for 10 years. I've owned them for 10 weeks because something happened, as with neutral tandem, in a very short period of time that took it to full value. But when I buy a stock, I do so with the full intention that I'm going to hold it until it works. And by the way, this has been pretty, caused some interesting situations. When we owned Atlas Pipeline at 19, we were pretty sure it was worth 32. So we bought the stock. That stock went to 4 in 2010 as everybody got a little worried about how much gas they would actually pump out of the Marcellus Shale. Eventually, the pipelines were turned on. The company went through some reorganizations, and we did, in fact, sell the stock at a premium to a valuation of 32. But we went from 19 to 4 first. The key is to have the valuation work right and be highly confident in it. Obviously, we added to our position on the way down because of the amount of confidence we had in it. One of the things I really bring to the table is the discipline and patience to hold a stock until it reaches the full value, again, whether it's 6 months or 6 years. I've been doing this a long time. I've seen a lot of situations like Atlas Pipeline. It becomes very hard to hold onto a stock when it's dropping in value. You have to be very confident of your valuation. The hardest time to hold on to a stock is when it's rising. When you buy a stock at 10 and it goes to 12 or 13 or 14 over a short period of time, there's such a temptation to book that gain because, after all, you can never go broke taking a profit is the mantra of Wall Street. However, if I buy it at 10 and I'm selling at 14 and that stock is actually worth 21, I'm doing myself a horrible disservice. It's very hard during the day, especially if you have CNBC or Bloomberg or one of the other financial channels on, and there's just all this action and everybody's excited and trading and they're buying and they're selling, and I compare it to a casino. You have to have an ability to sit still. I do not feel the need to play the game just because the casino is open. I'm not trading electronic blips or pieces of paper. In my eyes, I'm buying and selling a portfolio of businesses. They all have a defined value. I want to buy it at a huge discount to that value and sell it when it reaches a premium valuation. I don't want to do it just on chart patterns, volume, what's going on in the market today. I want to sell that stock based on what the business is worth, and I'm really not going to sell a stock until it's worked and reached that valuation. Okay, now here's one of the fun parts of valuation of deep value investing to me, because I'm not a market timer. I experimented with market timing and trading early in my career and figured out really good that I'm not good at it. I know some guys that are. I'm not one of them. But when you focus on valuation, you tend to create a natural timing mechanism for over and under investing in the stock market. When you have a drastic sell-off in the market, there's hundreds of cheap stocks around. In times like 2003 and 2008, it's like shooting fish in a barrel. The problem is to select the ones that you want to own the most, because there's probably more safe and cheap stocks than you can actually afford to buy, again, unless you're running one of these $20 million portfolios. As the market goes higher, your stocks start to hit full value, and you have limited replacement opportunities. There's fewer cheap stocks to replace them with. You're kind of seeing that now as some of the stuff that we bought in 2008 and 2009 is being sold because it's at its full intrinsic value, and there's not enough stocks to replace them to be fully invested at this time. So I'm not a market timer, but by focusing on valuation, you're buying when times are bad and everybody else is selling, and you're selling when everybody else is really excited about stocks and they're talking about it at the cocktail parties and everybody's just head over heels in love with the stock market. Because there's no cheap stocks, you're selling and moving to cash, which is exactly the right thing to do. Okay, now here's what I want to do with this service. First off, obviously I'm going to pick stocks. When I buy a stock, it's going to go up on the Marketfy platform. The minute I decide, bang, this is a buy, it'll be flashed out to everybody. Try to give you an update at that time what the company is, a little write-up of what the business is, why we like it, what the valuation ranges are. But then every day as corporate events happen, as earnings reports come out, other analysts on the street make comments on the stock, or there's an article about it that I think that you need to be aware of as an investor in the stock, I'm going to go ahead and get it up on the blog site and get it out to you on a very timely basis. The other thing that I want to do is be as educational and informative as possible. We've all seen stock services where they throw out a bunch of stocks and you should buy these stocks here at this price and you sell them at this price, and that's all very good, but you have absolutely no idea why you're doing it, except that this guy said so. What I want to try to do, if I see informational, educational articles, studies, anything that's going to help make you a better, more informed investor over time, I'm going to go ahead and get it up on that blog site and get it out to you so you can read it and learn from it. And also, this is new, I'm going to add this starting this weekend. Every week I'm going to go on that blog for the entire portfolio, and based on the price action of that week or the last couple of weeks, I'm going to tell you this is a buy right now stock. It's dropped back down a little bit. Go ahead and buy it if you've got new money coming in. Or, hey, this stock has moved up 10% in the last week. Let's not chase it. Hold off and see what happens. Don't buy it right now. I'll provide that for you each and every week in addition to the regular commentary and stock picks. Okay, now the Tim Melvin Deep Value Letter, we've thought a lot about exactly how to price this thing. And I've got a couple friends that run some services that are not dissimilar. They charge $2,000 to $10,000 a year or more. They aim at the institutional marketplace. They don't really want to deal with individuals. They want to deal with the larger funds, the asset allocators, the Wall Street analysts. I spent 20 years around those guys. I'd rather work with the individual investor. So I think we've targeted and priced this service for individual investors to help make you, first off, earn a higher rate of return. I think I can do that. I've done that for many years now in my personal accounts, the accounts that I manage for family and friends. We've consistently beat the market. In my columns and my articles over the last 5 years that I've been writing columns, the ideas that we presented have substantially outperformed the market. I think we can do that with a very targeted portfolio, and I think we've priced the service in a range that it can add a lot of value at a reasonable price for you. I've been doing this for a long time. I have learned from some of the absolute best in the business. I've made some refinements to the basic deep value investing approach that I think really is going to improve your chances of success over time. I think that I can help you consistently beat the market. I think I can do that at a fair price that adds value to your investment process, and along the way I'm going to try to educate you and occasionally even entertain you. So I think it's a great value, and I hope you'll join us.